Banks have woven a captivating tale, making us believe our money magically multiplies within their confines. True, the numbers climb with the allure of interest rates, but here's where the plot thickens. As our money count inflates, its true might in the market dwindles. With inflation soaring like an unstoppable force, those humble bank interest rates are left gasping in its wake. Think storing cash in banks is safe? Think again. It's like watching your hard-earned wealth turned to wisps of smoke. But hold on to your seats, because we've uncovered 6 legendary assets, the true titans of wealth preservation. Embark on this journey with us as we unveil these champions, ready to not just safeguard but amplify your wealth, promising a legacy that resonates through time. Dive in, subscribe, and together, let's chart a course to a richer tomorrow. Starting with number 1, divine wealth. Gold, silver, and platinum have long been viewed as the epitome of timeless wealth. The very essence of money's worth lies in its ability to preserve value over time. Yet, in our modern era, governments continually pump out more currency to cover their financial shortcomings. This raises questions about the long-term value of paper currencies like the dollar. This uncertainty is precisely why many financial experts advocate diversifying investments into tangible assets that are both rare and non-reproducible. It's no secret that affluent investors often allocate a segment of their portfolios for these revered metals. The appeal: precious metals, especially gold, have historically served as a hedge against inflation. For instance, an ounce of gold, which cost $400 before the 1950s, has soared past $2,000 in 2023. And if predictions by Prime XBT are anything to go by, we might see it reach a staggering $10,000 by 2032. This implies that gold's value could potentially quintuple in a decade. As paper currency values waver, gold continues its ascent, with silver and platinum also making their mark as potent alternatives to cash reserves. For those intrigued by the prospect of adding gold to their investment mix, hesitant about managing physical bullion, gold ETFs or exchange-traded funds present a viable option. These funds mirror gold's market performance, offering an accessible route to capitalize on its price movements without the need to physically possess the metal. Number 2. Essential industrial raw goods. While the rarity of precious metals plays a role in their value, their practical applications also add to their allure. Metals like silver aren't just valued for their sheen. They're cornerstones in industries, finding uses in everything from electronics to medical devices and even nuclear reactors. The same goes for metals like cobalt, nickel, and copper. Their unique irreplaceable properties make them highly sought after in various industries. To illustrate, consider cobalt's rise to prominence. Since 2020, its demand has surged, primarily because of its pivotal role in battery production for electric vehicles. This increased need is reflected in its market value, a jump from $20,000 per ton in 2012 to a whopping $40,000 in 2022. That's a doubling in price over a mere decade. Having a stake in such commodities can be a game changer for your investment strategy, especially during periods of heightened demand. Yet diving into the world of raw material investments might seem daunting for many. After all, directly buying, storing, and then selling these materials isn't feasible to everyone. Thankfully, there are many other pathways. Consider investing in shares of mining giants like Rio Tinto or explore mining-centric mutual funds. If you're looking for more dynamic options, derivatives such as futures and options can also be avenues to tap into the potential of these essential commodities. If you're finding this video insightful, please consider taking a moment to like down below. Now going back to number 3, sanctuary currencies, the financial safe houses. In today's age of fiat currencies, where money isn't tied to tangible assets like gold, the political and economic stability of a country becomes paramount when considering investments. This is the very reason why the wealthy often gravitate towards Swiss banks. With its robust economic foundation and political calm, Switzerland offers a haven for investments, making the Swiss franc a sought-after asset during global uncertainties. Historical events have demonstrated this trend clearly. Be it the Eurozone debt crisis of 2009 or the global financial debacle in 2008, investors rushed to Switzerland seeking refuge from potential financial loss caused by dwindling currency values. Moreover, the Swiss franc isn't just a hedge against economic instability. It also serves as a viable trading alternative to the omnipresent US dollar. For instance, amid the Russia-Ukraine conflict, when the US slapped sanctions on Russian trade, transactions shifted to the Swiss franc. This surge in demand caused the franc's value to spike. By early 2023, one Swiss franc was equivalent to 1.1074 US dollars, a windfall for those holding onto this currency. Top-tier currencies, including the Swiss franc, British pound, and Chinese yuan, are a treasured reservoir of value. And while having a Swiss bank account might not be feasible for everyone, there are alternatives. Platforms like currency ETFs and forex brokers, such as forex.com, offer even small-scale investors a slice of the action, starting with investments as modest as $100. Number 4. The strength of state backing, sovereign guarantee. Ever taking a moment to examine a dollar bill closely? Imprinted on it is the declaration, "This note is legal tender for all debts, public and private." Now, what does that signify? Back in 1971, President Nixon put an end to the gold standard, transitioning the dollar into legal currency by US law. While it's no longer tied to a tangible asset like gold, the value of the dollar, and indeed any fiat currency, is anchored in the trust and creditworthiness of the issuing government. In simpler terms, the stability of your money hinges on the robustness of the backing government. Sovereign guarantees, therefore, present a potent means to preserve and grow wealth. A nation's government is typically the last line of defense against default. If it collapses financially, the entire country's economy could crumble. Hence, investments in government securities, often called G-SECs, offer a certain level of security. However, it's essential to tread with caution. Stick to G-SECs from governments with strong credit ratings. A lesson from history: the 2009 sovereign debt crisis in Greece, where major international bodies had to intervene multiple times to stabilize the situation. For those in the US, treasury bills, notes, and bonds serves as avenues to tap into the might of sovereign guarantees. Not only do they tend to yield better returns than the traditional bank savings, but they also come with the assurance of the US government's global standing. Even for smaller investors, these instruments are accessible. They can be directly purchased from the government via the Treasury Direct platform or acquired on the secondary market. Number 5. Delving into value stocks and mutual funds. While Treasury investments outshine cash in terms of returns, they typically lag behind the potential earnings from stocks due to their low-risk nature. While many investors prioritize safety, there's a universal appetite for better returns. This is where stocks come into play. However, it's essential to note that not all stocks carry the same risk. Generally, the stock market categorizes stocks into two groups: growth stocks and value stocks. Growth stocks, like those in the tech sector, often come with higher risks. They're rooted in evolving ideas and innovations, which may or may not find success. On the other hand, value stocks, like those representing industrial metals such as Nucor, are typically more stable. Their demand is anticipated to remain consistent for the long run. Value stocks, especially those with a solid foundation, promise not only consistent growth in their valuation, but also deliver regular dividends. But here's the catch. Sifting through value stocks to understand their fundamentals can be a daunting task for the average investor. This is where mutual funds, specifically those centered on dividends, come into the spotlight. Funds like the Vanguard High Dividend Yield Index Fund Annual Shares have a track record of consistent dividend payouts, making them an attractive and more accessible option for individual investors. Number 6. The enduring value of land and property. Land, for accountants, stand out as an asset that doesn't diminish in value, primarily due to its limited availability and evergreen demand. Throughout history, land has always been a prized possession, serving various purposes from housing to education, industry, agriculture, and commercial endeavors. This continuous need, amplified by a burgeoning population, ensures that its value won't dwindle over time. Likewise, structures like houses, office spaces, and commercial units are always sought after. Consequently, investing in land and buildings is a reliable defense against inflation. To provide some context, a Bloomberg report noted that despite the 2008 market downturn, housing prices tripled from 1992 to the 2020s. While many associate real estate investments with later stages of life, primarily centered around home ownership, the benefits of early investment can't be overstated. Importantly, diving into the real estate market doesn't mean you have to commit substantial funds. REITs, or real estate investment trusts, offer a gateway to the property sector, operating similarly to mutual funds. Ventus Incorporated, or VTR, a renowned REIT in the US, primarily focuses on healthcare properties such as senior living facilities, research centers, and hospitals. Alternatively, some choose to secure loans to buy rental assets, with the rent covering operational costs, loan repayments, and even turning a profit. And because you've stuck around with us through the whole video, we're going to give you a bonus 1. With number 7, the allure of collectibles. There's an undeniable charm associated with the collectibles. This category boasts an array of items like classic cars, art masterpieces, bespoke luxury bags, exclusive watches, and first edition legendary books. Unlike a new vehicle, which typically loses value once driven, classic cars often appreciate over time, similar to fine wines. To illustrate, a 1995 Mercedes-Benz 300 SLR Uhlenhaut Coupe, one of only 2 ever made, fetched a staggering 135 million euros in 2022, as reported by Autocar. In another instance, the art world was abuzz in 2017 when Leonardo da Vinci's disputed painting, Salvator Mundi, was purchased for a jaw-dropping $450 million at a Christie's auction by a Saudi royal. Affluent individuals splurge on such limited edition items because they encapsulate enduring value, often commanding higher prices if matched with the right buyer. While investing in these collectibles might seem unattainable for most, modern online platforms offer alternatives. Sites like Whatnot provide avenues for trading unique items like rare baseball cards, comics, and action figures. Moreover, platforms like Convey and Masterworks have made strides in offering fractional ownership of collectibles, making it accessible to our broader audience. Hey everyone! Thank you so much for tuning in and watching today's video. If you found it helpful or enjoyable, don't forget to hit the like button and consider subscribing for more content. Your support truly means the world to us. Drop any questions or suggestions in the comments below, and we'll do our best to get back to you. Until next time, take care and see you in the next video.